Most traders in India don't realize this. The way you receive your prop firm payout can completely change how much tax you owe and even decide whether your bank account stays safe or gets flagged. If you're a trader earning payouts from prop firms, stay till the end because this video will save you a lot of confusion and maybe a lot of money. As a disclaimer, these are general explanations based on Indian tax laws. Always consult a qualified tax professional before making any financial or tax decisions. Now, let's start with something simple. Prop trading in India exists in what's called a gray zone. It's not banned, but it's not officially recognized like normal stock or F&O trading either. So your tax treatment depends entirely on how you receive the money and how you report it. In simple words, the payout route you choose decides whether you pay 5% or 30% tax. There are 5 major rules that affect every Indian prop trader. The Income Tax Act, the FEMA Act, which controls foreign exchange, the rules for crypto taxation, the anti-money laundering laws, and sometimes GST if you operate it like a business or service. Now, don't worry. You don't have to memorize those. I'll explain how they show up in your day-to-day trading life with simple examples. Let's start with a basic one. Imagine you make 1 lakh in profit from a prop firm. Now, depending on how you receive it, that 1 lakh can be taxed in 2 totally different ways. If your payout is treated as crypto income, you'll pay 30% tax plus cess, so roughly 34% in total. Out of 1 lakh profit, you'll lose about $34,000 in taxes. But if you report that same payout as business income under something like freelance research analyst or market research work, the rate depends on your income slab. For example, someone earning 6 lakh a year might pay less than 10%, while someone earning 25 lakh might reach 30%. Same payout, same profit, completely different result. That's why knowing how to treat your prop firm income correctly matters more than anything else. Now, let's talk about how you receive the payout. This is where most traders make mistakes. There are 4 main routes. Direct bank transfer, through payment platforms like Rise, through crypto using an FIU-registered exchange, or through a decentralized wallet like Trust Wallet or MetaMask. And each of them is treated differently for tax purposes. First, direct bank transfer. If the prop firm sends your payout directly to your Indian bank, that's the easiest route. Just report it as business income or freelance income. It's the cleanest way because there's no crypto layer, no confusion. The only thing to watch is that your transaction history looks consistent. If you had 0 income last year and suddenly deposit 10 lakh this year, the bank will notice. So build a pattern. Second, through Rise or similar platforms. Many prop firms now use middle platforms that pay in crypto or stable coins like USDT. When that money hits your wallet and then your exchange, the tax story changes. The income tax department treats that as crypto income. Flat 30%, no expense deductions, no offset of losses, and an extra 4% cess. Even if you lose on other trades, you can't adjust those losses here. That's why for Indian traders, this route is risky if you don't plan taxes properly. Third, crypto through FIU-registered exchanges. If you receive payouts in crypto and sell it through an Indian exchange like CoinDCX or WazirX, that exchange automatically deducts 1% TDS. That's regardless of whether you made profit or loss. If you made 1 lakh, they'll keep 1,000. If you made nothing, they'll still keep 1,000. Then, when you sell your crypto, 30% tax applies on your gains. You also can't claim any expenses like exchange fees or interest costs. So it's the highest tax route of all. Fourth, decentralized wallets. This one sounds clever, but can get tricky. A lot of traders think that if they receive prop payouts in a wallet like MetaMask, the government can't see it. But the moment you make even one transaction from that wallet to a registered exchange, it becomes traceable. That wallet is now connected to your KYC, and every coin in it becomes part of your taxable world, even the coins that were there before. If you never move them to any Indian exchange, they still count as your assets. And by the end of the financial year, whatever price that crypto is trading at on March 31st, you may still be liable to pay tax on that value. So, holding it doesn't make it disappear. It just delays the problem. Now let's talk about the part most people ignore: bank freezing. If your bank suddenly receives random large amounts or multiple payments from unknown senders, that could trigger a compliance flag. Many traders learned this the hard way. They took P2P transfers through unknown people or received payments from random accounts, and within a week their bank was frozen. It's not that you did something criminal. It's just how Indian banks are programmed now. The system looks for unusual activity, and prop payouts through P2P look exactly like that. A safer approach is to use one consistent account and show the income as freelance or business activity. If you need a crypto-friendly bank, some fintech banks like Revolut or Wirex are used internationally, though you must check if they accept Indian residents. Now that we've covered the risks, let's talk about how to legally reduce taxes. The first way is simple. File your income under the business and profession category, not under crypto gains. That allows you to claim business expenses like internet, trading software, electricity, or even a small home office deduction. You can also set off losses from one trade against profits from another. The second way is by trading under an F&O style setup. In India, futures and options trading are treated as business income, not as crypto. If your prop payouts are linked to derivative contracts, you can use that category. That means you pay tax based on your normal income slab, not the fixed 30% crypto rate. The third way is something only few people know. You can create an HUF account, which stands for Hindu Undivided Family. That gives you a completely separate tax entity with its own 24 lakh slab before 30% applies. So, if you personally make 24 lakh and your HUF also makes 24 lakh, your total family income can be 48 lakh while still paying under the top slab. It's legal, smart, and used by many business families across India. Now let's talk about traders who get paid directly in crypto. If your prop firm pays you in USDT, Bitcoin, or Ethereum, and you convert that into INR, the gain is taxed at 30%. If you keep it in crypto form, it's still taxable based on its market value when a year ends. The rule is simple. The moment you sell or convert it, it becomes a taxable event. For example, let's say you received 1,000 USDT when it was worth 83 rupees per dollar. You waited a few months and then sold it when it became 90. That 7 rupees difference is your profit, and 30% of that must be paid as tax. Even if you use that crypto to buy something, it still counts as selling. Some traders use Pay cards or similar options that let you spend crypto directly at stores or withdraw cash from ATMs. That's convenient, but remember, it only hides the path, not the source. If your money came from trading, the tax still applies. You can avoid a frozen bank account by using these cards, but you can't avoid taxes. So don't mistake ease of spending for tax-free income. Let's take a short break here. If you're getting value from this video, hit the like button and subscribe to the channel. It really helps the algorithm show this to more traders like you. And if you want to find the best prop firms available for Indian traders, I've listed them along with promo codes in the pinned comment below. Using those links also helps support my work. Now let's get back to the important part: moving abroad for tax benefits. Many traders start thinking about shifting to places like Dubai once they start making consistent profits. And honestly, that's for a reason. Dubai has 0% tax on trading profits. No capital gains, no income tax, no crypto restrictions. But there's a catch. If you're still considered a tax resident of India, Indian laws still apply. So before moving, you need to actually change your tax residency. There are a few ways. You can get an employment visa if you work there. You can get an investor visa if you buy property worth around 750,000 dirhams, which is roughly 1 crore 90 lakh rupees. Or you can open a free zone company, which costs less and allows you to trade legally while living in Dubai. It's the most common path for traders because you can set it up remotely and use it for prop trading without any problem. Let's get back to India now. If you're staying here, your main job is to file your taxes correctly. Whether you're a student, freelancer, or working a job, you can report your trading income onto the same ITR. Use the right category, salary income for your job, and business or other income for trading. It's simple, and once you do it right, you'll sleep better knowing your record is clean. A lot of traders fear the word tax, but it's actually protection. If you show where your money came from, the government can't question you later. Not filing is what causes trouble, not earning. Now, let's talk about one more mistake traders make. They use too many wallets and accounts. They take payouts in different names or mix personal and trading money. That's a recipe for confusion. Pick one wallet for prop payouts. Use one bank for withdrawals. Keep screenshots and records of every transaction. If a notice ever comes, you can prove your income is from trading, not random transfers. Let's recap what we've learned. In India, prop firm income can fall under two categories. Business income, where the tax rate depends on your slab, or crypto income, which is fixed at 30%. You can't offset losses in crypto, but you can in business income. You can claim expenses and even get an extra tax entity if you use an HUF. Avoid P2P transfers and unknown accounts, or your bank might freeze funds. Decentralized wallets aren't invisible once you connect them to an exchange. And tools like Re.Pay make payments easier, but don't remove your tax responsibility. The best approach is to stay compliant and strategic. Now that you understand how prop firm taxes actually work in India, use this knowledge to protect your profits. Always verify the details with a certified CA before filing. And if you want to know which prop firms are best for Indian traders, I've listed them with exclusive promo codes in the pinned comment below. Using those links helps the channel continue bringing you real trading value every week. Don't forget to like this video, subscribe, and share it with another trader who's probably still confused about taxes. This is the knowledge that separates smart traders from the ones who get caught off guard. Keep learning, trade smart, and I'll see you in the next video.